All right, everybody, let's dive in and get started. Welcome to the monthly webinar series, educational series that I'm putting together. My name is Senate Eskridge. I am, tell you a little bit about myself before we get started. I am a multifamily investor. I have invested in over 700 units. I've done 18 deals across Oklahoma, Idaho, Texas, Ohio, and North Carolina, actively working on growing the footprint and growing the unit count. I'm also a real estate coach. I teach people how to buy multifamily apartment buildings and invest in those multifamily apartment buildings. Something I'm passionate about is educating people and making sure that they know what they're doing so they don't have to learn from the mistakes, making the mistakes like I did. I can teach them and save them those mistakes from doing that on their own. All right, so we're going to go for probably about 30 minutes today and save time for questions at the end. So please, as we're going through this, put any questions you have into the Q&A, and they may get addressed as we go along, but I will definitely save time at the end for questions. All right, so let's dive in. First and foremost, let's talk about traditional real estate investing. And by that, I mean, we're talking about buying houses and renting them out and being a landlord. What I say about that is anybody can buy a house or a duplex and rent it out. And I mean that. There's so many programs out there and ways that you can go about this. One of the very popular thing is called house hacking, where you buy a duplex or bigger and you live in one unit and you rent out the others, or even a single family house and you rent out bedrooms and things like that. And basically, you take a house and you find a way to generate income off of it, i.e. house hacking. There's another program called Burr and several other ones out there that are just absolutely phenomenal. And I did a lot of this when I very first got started in real estate. And it's a good program. These are good things for some people. There's a lot of advantages to investing in single family houses and duplexes and things like that. There's a few pros up here on the screen we'll talk through. You know, like I said, anybody can get it. There's a low barrier to entry. There's a low down payment, and there's tons and tons of houses on the market. Some of them are good deals, some of them aren't good deals. I'm not saying that they're all good deals, but you can just pull up realtor.com on your phone and go and find a house. And if it's a good deal, go ahead and buy it. And there's tons of property managers that can manage these. And getting credit approval is typically pretty easy for some of these, especially for your first one. You know, there's great programs for FHA and first-time home buyers and things. But there's a lot of disadvantages too. One of the biggest ones is risk. I love real estate. I love real estate investing, but I believe there's nothing riskier than owning one single family house or one single family rental. And let me explain what I mean by that. When you have one unit, you know, the average across the nation, you're going to make approximately $200 a month per unit that you have profit. So that's what, $2,400 a year. Well, ask yourself, when was the last time you had a professional put in a water heater or a furnace, or you had to replace the main line, plumbing line to a house? I think you can easily see that that can quickly eat up an entire year's profit very quickly with repairs. But what about vacancy? If that property is vacant, how much money are you making? Well, the answer is zero. And actually it's negative because you still have to pay all the bills. You still have to pay the property tax. You still have to pay the insurance. You still have to pay even utilities, right? Because you've got to keep it on and going so that you can show it. And if you live in a cold climate, you got to make sure it doesn't freeze during the winter time. So there's a ton of risk on that. And as you scale into bigger properties, that risk lowers. You can also do that, lower that risk by spreading that across multiple houses. But that's why I say having one single family house is one of the riskiest investments that you can do. We've already talked about the low profit. You're going to average about $200 per month per unit. And one of the biggest things for me is that it's a slow buildup. It takes a long time to get there. There's a few other things on here that are key, but one of the biggest one is lack of professional management. There's a lot of good property managers out there that do a great job, but they're not what I would call industrial grade or professional grade. These really high-end property managers really only work on bigger properties. And so if you don't have 30, 40 units, something like that, it's really hard to find the really like that professional grade property management. So there's just tons of things on there. And at the end of the day, it's just a job. If you're making $2,400 a year or $200 a month, and you're putting 2 hours a month into every unit or 4 hours a month into every unit, that's $50 an hour. It's pretty good pay, but it's still a job. So let's talk about the other options. The other option, what we're really here to talk about, is how to become a limited partner and invest in other people's deals. And what I mean by that is someone like myself or another investor goes out and they buy a bigger apartment complex, and you come in there and buy it. Now, conversely to a single family house where anybody can buy it, these require special skills, a big team, and quite a bit of money. And what we do is we have the skills, we have the team, and then we pool people's money together. A little bit of your money, a little bit of their money, and everybody just gets to sit back and collect the benefits. And that's what being a passive investor as a limited partner is. You get to take a little bit of your money and put it in multiple different deals. And then our team handles all of the troubles, all of the headaches, and you just get to sit back and reap all the benefits. Benefits are like things like high returns, 15 to 25% IRR on here, which stands for internal rate of return. I realize there's a little bit of jargon. In the future, I'm going to have a webinar that just talks about jargon and terms and things that people need to know. But this basically is the returns that you're going to get over the timeline. And one of the biggest ones is tax advantages. That one of the secrets of the wealthy is to pay their fair share of taxes, but no more. And the real estate is very well incentivized. The government gives you benefits for doing things that they want you to do, and providing housing for the people who live in the United States is one of the things that they really, really incentivize. So let's talk about the pros and cons of investing in a syndication, because there are big advantages and a couple of small disadvantages too. One of the biggest ones is that low barrier to entry. For a similar amount that you would invest in a down payment on a single family house, you can get into a syndication. And that gives you really the ability to invest in multiple deals. Imagine having, say, $50,000 invested across 5 deals or 10 deals, rather than having 250 in 2 or 500,000 in 1. You really get the diversification. So if there's a problem with one something doesn't go well, then the other ones offset it. There's very limited risk. The term limited partner means that you have limited risk in the syndication. So essentially, if everything goes wrong and nothing goes well, and just worst case scenario, you're out your investment that you put into it. They're never going to come after other assets that you have, your house or your cars or your retirement accounts. There's very little risk other than what you've put into the investment. Now, I'm not saying that they're risk-free. There are challenges. There is no free lunch, but they're not going to come after your other assets. Scale is something that is really, really big advantage. We talked about that single family house and the cost of putting in a new hot water heater or a main line, and also the occupancy or the vacancy. Imagine now spreading that across 100 units. It gets a lot easier to pay for a furnace when you have 100 different units. Even if you only are making that $200 a month we talked about earlier, now that's $20,000 a month that you can use to pay for repairs and things of that nature. And also the vacancy. If you have 1 or 2 or 3 units empty on a 100-unit property, you can easily cover all of your bills. On average, the properties that I look at, the break-even occupancy, that's something that's a really key metric that you look at when you're underwriting a deal and deciding whether or not it's a good deal, is somewhere around 75%, 70 to 80. So let's use 80 to be conservative in this number. If you had 100 units and your break-even occupancy was 80%, that means you can have 20 empty units on a 100-unit property and still be able to pay all the bills. It really lowers that risk down. And the next thing that really lowers it is having professional property management. These people are professionals at what they do. They have teams of people. They have things like on-site property managers that work there 8 to 5 at the physical property, on-site handymen, regional managers, professional like accountants that work in there. There's just so many benefits that those smaller property managers that do single family houses, they literally just can't afford to do. And the next one is these tax benefits. I'm going to do an entire webinar very soon about what the tax benefits are of investing in syndications, multifamily specifically. But just to hit the nail on the head real quick, we use a thing called a cost segregation to break out all the components of a property, and we can write those off in accelerated timeframes. And then we can use a thing called bonus depreciation to pack the majority of those write-offs into year 1 or even into year 2. And now that's eligible in single family houses as well. You can do it, but those studies are very expensive and it makes it not feasible when you only have one property or a duplex or a triplex. It's just not worth paying to get that to happen. There's not enough benefits to offset the cost. So this is another opportunity to take advantage of that scale. Now, you can tell I really like syndications, but I want to be clear, there are some negatives, some cons as well. And the one I put on here is lack of control. At the end of the day, someone else is in charge of the property. Now, some people say that's a good thing. Some people say, that's a bad thing. They want a little bit more control and say. Now, if you work with an operator like myself, you can always reach out to me. You can ask questions. You can give me input, those types of things. But at the end of the day, the syndicator, the lead sponsor, the person who's in charge of running it, they're going to make the decisions on your behalf. Now, that does lead back to a pro, right? It's completely passive income. You put the money in, these people do all the work, and you get the benefits, including the income, but you do have that lack of control. And something I didn't put on here that I probably should have, I do want to point out, there is some risk, right? This isn't a free lunch. Sometimes there are problems, and sometimes that lowers the returns, and it is a possibility that there are some risks. I just don't want you to ever think that there aren't any risks. All right, so I want to show you an example of a deal that I'm working on right now, just to show you the types of deals that we do. So this is an example of a build-to-rent development that I'm doing, partnering with another developer. This is in New Braunfels, Texas. We're literally building these townhomes from scratch. And it's 127 of these. It's going to take 3 years to finish this project. It's in 2 different phases, but we're going to double the investor's money in just over 3 years. So it's a 2.04 times equity multiple, which just means that we're going to double the money. And when you do the math on that, that comes out to a 32% average annual return. And what that means is you take the money that's invested and then the return, and you divide that across the time that the money's invested. And then we all talked about that depreciation earlier, those tax write-offs. We're going to do $50,000, basically half of whatever has been invested gets put into a tax write-off, $25,000 this year and $25,000 next year. And if somebody put in 200, that would double, right? It's half of what is invested. And there's 6% cash flow starting at the end of the first quarter after somebody invests. I put this in here, as I mentioned, just as an example of the types of deals that these people can invest in. You put your $50,000, $100,000, $200,000 into one of these deals, and the developer does all the work, and in 3 years, they're going to double that money back to you. This is a little bit more detail just about the returns. I'm going to skip over that. So one of the most important things that you need to do when you're looking at a syndication is choosing the right partner to work with. This is where I think people need to spend the majority of the time. When I'm talking to new investors, it's very common that they spend the majority of their time analyzing the deal and trying to figure out, hey, is this deal the right deal for me to invest in? And I completely understand why that is the natural thing. People they want to know what's going on. More important, though, is the people running the deal, the person who's mainly in charge of the property. I wish people would spend more time asking me about myself and my experience and my partners than the individual deal. It's not because I'm not happy to tell them about the deal, totally happy to answer all those questions. But somebody really smart once said to me that a good operator can take an average deal and turn it into a home run. But a bad operator can take an amazing deal and drive it into the ground. So this is the most important part. So you need to learn about the sponsor's track record, their real estate knowledge and resources, their personality. You have to get along with these people. You're going to be in business with them for a short one. A short deal is 3 years. Most of them are about 5 years. Sometimes they're as long as 7. And I've seen a few even as long as 10 years. So you really have to get along with the people. Make sure they're responsive, that they communicate in the same way that you do. I put a couple questions up here to ask. And the thing is, these questions, it's not really what the answer is that's important, is that they have an answer and that they're confident in that answer. And if they don't have the answer, that they don't make it up, they go figure it out and get you an answer back. So really spend a lot of time asking questions about the team that you're working with. So let's talk about what's next. What are the steps to invest in one of these things? So I should have put on here, get on an investor's or a sponsor's list, right? So people like myself, we're going to send emails out to you to be able to get on the list. And then we're going to advertise our deals. And there are rules about advertising, and we'll talk in the future about the difference between a 506B syndication, where you have to have a special relationship with the sponsor, or a 506C, where they can advertise publicly and things like that. But you start by getting on a sponsor's email list. The sponsor announces the opportunity, and it's just like, hey, I've got an opportunity to invest. about a deal. And this is just typically a quick email where they're going to send out the summary of the property. And most of the time, they're going to have an investor webinar. I highly recommend you read the investor deck, you watch the investor webinar, and you get some questions answered. Then you do what's called a soft commitment. And what this is it's just you raising your hand and saying, hey, yeah, I want to invest, and this is what I think I want to invest. And then they're going to send you what's called a PPM, or a private placement memorandum. Now, this is the actual offer to invest. This is the point where you can actually say, yes, I want to invest in this deal. Some of these things are fairly lengthy. I've seen them as short as 50 pages, as long as 200 pages, and it really outlines all the risks, all the requirements, what you're investing in, what the timeline is, the information about the sponsors, information about the deal. You really need to take some time and understand that. And then you sign that. And then the next step is you wire your funds. And then the property closes. They actually buy the property and then they own it. And you become a member of the LLC that owns the property. And then your job after that, I say investors have 3 jobs. So number 1 is they need to read the monthly update, understand what's going on the property. Number 2, they need to cash the checks. And number 3, they need to send the tax document. It's called a K-1, which is very similar to a 1099 or W-2. You have to send that to your accountant at the end of the year. That's really it. So, little ahead of schedule here. A little bit of information about me. If you want to get on my investor list and get to know what it is that I'm doing and watch out for my deals, this is my website. It's senateskridge.com. You put in /invest and it'll take you to a page to apply to invest with me. And on there, you can even set up a meeting. We'll have a quick 15-minute chat, get to know each other. And now you're in my database, and I'll be able to send you all of my deals going forward. There's a ton of other resources on my website, webinars I've done, and podcasts I've attended. My books are on there. My blog's on there, tons of information available for you. So jump on my website, apply to invest with me, and watch for my future webinars. I'm going to do these once a month, and I'll come up with ways to educate you and give you tips. My email address is on there as well. If you have any suggestions for a webinar or a topic that you want to know about, don't hesitate to give me that suggestion, and I'll put it out there. So with that, thank you all for attending, and I look forward to speaking with you next month. Thanks, everybody.